Good day and welcome. This is a brief review of what transpired in investment markets over the past quarter and its impact on our momentum branded solutions. It is difficult to believe that we are at this point in time more than 12 months down the road from the height of market volatility we experienced, as well as the lowest point of the market sell-off that was brought about by the COVID-19 pandemic. Investment markets have subsequently recovered to the point where both the last quarter as well as the last 12 months return make for very different and more palatable reading. The last quarter saw risky asset classes enjoying improved returns, as global bonds started fretting about the potential for tighter monetary policy. As a result, global bond returns were particularly poor this quarter, returning a negative 4.7%, falling far short of the positive returns provided by both SA equities and global equities, with both asset classes returning 12.6% and 5.6% respectively. SA equities also outperformed domestic asset classes, whether local property, inflation-linked bonds, or nominal bonds that ended the quarter 1.7% lower. I'm pleased to report that our focus and target fund of fund ranges participated handsomely in the recovery post of March, posting exceptionally good returns over both the shorter and medium term, and on an absolute and peer relative basis. It again confirms one of the key pillars of our investment philosophy, that one should stay invested for the longer term. While market-linked solutions fared extremely well over this period, we continue to look for additional and innovative investment strategies to build on these successes. This is especially important given the disappointing and depressed growth experience from traditional growth asset classes, including domestic equities and property, that failed to deliver over the past 5 years. This has had a direct hand in multi-asset class solutions struggling to keep pace with elevated CPI-linked investment objectives. We've seen strong returns from a multiple components or building blocks within our product ranges. Our domestic equity component continues to fare exceptionally well, and we've also seen and experienced a strong recovery in both global equities as well as the domestic fixed income components, adding to both our absolute and relative returns. Looking ahead to the second quarter and the remainder of 2021, we maintain the view that risky asset classes should continue to benefit from the ongoing recovery in global growth as long as current supportive monetary and fiscal policy settings remain in place. We maintain a healthy exposure to domestic and offshore equities as a result. We expect returns from SA asset classes, particularly local equities, to benefit from such a conducive global risk-on environment, as well as from a more favorable valuation aspect. SA nominal and inflation-linked bonds do look attractive, but we are less optimistic about the domestic cash and listed property asset classes.